well, stay put. My message is, it is less bad than we feared a couple of months ago. But less bad doesn't quite yet mean good. Let me start from what has improved and why we have to be cautious. What has improved is inflation seems to have started leading in the right direction, in other words, down. Headline inflation in particular. What has improved is the prospect for China to boost growth. Let's remember last year, 22, China registered for a first time in 40 years lower growth rate than the global average. Never happened in 4 decades. Now, with the reopening of China, we expect growth this year to again exceed global average. We project 2.7% for the world. This may be corrected somewhat in a couple of days. For China, we project 4.4%. And what has changed in the positive is that we have seen demonstrably strength of labor markets translating into consumers spending and keeping the economy up. Why we should be cautious? Well, first, 2.7, if this is the growth we achieve, by far is not fabulous. This is the third lowest growth rate in the last decades after the global financial crisis and COVID. It's not great. Second, we don't know quite yet how inflation would march downwards. What if the good news of China growing faster translates into oil and gas prices jumping up, putting pressure on inflation? And three, the horrible war in Ukraine is a risk for primarily the people of Ukraine, but it is also a tremendous risk for confidence, especially in Europe. So, conclusion, be careful not to get on the other side of the spectrum from being too pessimistic to being too optimistic. Stay in the middle of realism that seems to serve the world well. And if I may finish on the issue of fragmentation, if we look at medium-term growth prospects, how we handle security of supply chains would matter tremendously on our future prospects of growth. If we diversify rationally, the cost of this adjustment would be low. We put it down to 0.2% of GDP. If we are like an elephant in a china shop and we trash the trade that has been an engine for growth for so many decades, the cost can go up to 7% loss of GDP, $7 trillion. So a great deal of whether we can lift up optimism depends on the people in this room. Be pragmatic, collaborate, do the right thing, keep the global economy integrated for the benefit of all of us. Well, we look at the last year, we have downgraded our projections 3 times. So not downgrading is already good news. Whether we would upgrade, and if we do so, how much we will see in 10 days. But I can tell you, it is not going to be a dramatic improvement vis-a-vis what I'm projecting right now, the 2.7%. And let's be very honest. whether Germany finishes 2023 with minus 0.3%, which was our October projection, or they finish with plus 0.5%, which may be our new, the projection may go up to that level. Still, for hundreds of millions of people in Germany, all over Europe, in the world, when we are at this low level of growth, it would be painful. And let me send the biggest caution I could today. Labor markets are holding firm so far, but interest rates are yet to bite. And if they bite more severely, then we can see unemployment going up. And it is very different for a consumer to have cost of living crisis and a job than to have cost of living crisis and no job. So we have to be thinking of possibly unemployment going up at a time when fiscal space in governments is very tight. There isn't that much they can do to help people, and yet they would be pressed to do it. Christine, then all the power to you. If fiscal policy works against purpose with monetary policy, then you may have to tighten even further.